Right, since we have someone in, we can start. Welcome to the TRG. So we have had, 3 classes before this. The first 2, we did MCQs, and when we did the questions, I kind of brushed your knowledge with regard to that particular area. And the third class, we entirely gave it for variance analysis. Reason being that if I didn't do that, I wouldn't be able to do any variance question. Even if I do it, you won't really benefit from it because you wouldn't understand what's going on. Okay. So the third class, I entirely dedicated it to teaching you variance analysis from scratch. So now we are into the 4th and the 5th classes. So what we will do is, just like in the first 2 classes, we will continue with different questions from different areas of the syllabus. So it won't be just from one area, it will come from different areas. So the idea is that every time we do a question, we will, kind of talk a little bit about the background of that area, and then we will answer the question. So hopefully by the end of these 2 days, we would have spoken about at least 90% of your MA chapters. So almost 90% of all your chapters should be covered in some way or the other. Okay, so that is the idea. Right, so let's begin. One more thing, all these TRGs, they're recorded. So if you want access to them, you can always reach out to us. And the other thing is, even if somebody, if one of you is joining in a little late, or, for some reason you were only able to come for the second half of the lecture or anything like that, it shouldn't be a problem because this is MA. So every question is a standalone question. I'm not doing any long questions. So if you join in late, doesn't matter. Just forget the question that we're doing. The next question that we start will anyway be fresh. Okay, so that shouldn't be a problem with regard to MA. Right. So let me just check if everything is fine. Yeah, you can see. Okay. Right, so let's continue. This mixed bank, these questions I have shared on the Telegram group. So all of you should have access to it. Once we're done with the TRG, I will share the answers as well. Okay, so you should have complete access to everything. Right. So let's look at 20.9, which is where we stopped. The following statements relate to spreadsheets. Which statement is false? Okay, so there's nothing much to talk about spreadsheets. It's just that we have to understand that as accountants, we have to become more familiar with using spreadsheets. Okay, because when it comes to the workplace, nobody is actually using pen and paper, right? So spreadsheets is an area that you should ideally be familiar and comfortable with. All right. So we just talk about that when it comes to the syllabus. We just dedicate one entire chapter just to tell you that spreadsheets are important. Okay. Right. So which statement is false? A is saying they are an efficient method of storing text-based files. So you guys are, I don't know, probably from the millennial generation. You must be knowing about spreadsheets, obviously. Think about it. Can you use something like Microsoft Excel to store a text-based file? Or is there a better alternative? Think about it. Either if you are going to write an essay, for example, will you use Excel or will you use Word? Obviously, Word is going to be a better option, right? Because if you're going to have entirely text, then you can't write everything in one cell, in Excel. So it's better to, opt for Microsoft Word. So the first statement, they're saying it's efficient method of storing text-based files. It may not be true. Okay, because a spreadsheet is efficient to store numbers, numerical data. Okay, so A can't be the answer. I'm sorry, A is false. So yeah, that will be the answer. Let's anyway just read B as well. They say they facilitate what if analysis. Okay, so although this question is not asking what it is, let's just talk about what if analysis a bit. Okay, so there is another term that we use. You might be more familiar with it. We call it sensitivity analysis. You might have seen this more often than what if analysis. Both are referring to the same. Okay. So what is this what if analysis or sensitivity analysis? It's like this. Now, before we invest in a project, okay, before we invest, we, use different investment appraisal techniques to decide whether this investment is worthwhile or not. For example, we can use the NPV, net present value. We can use IRR. We can use payback. So there are many techniques that you can, models basically, that you can use to decide whether you have to invest in this project or some other project. We don't have any doubt about that. But the thing is, when we, for example, let's say we are going to use NPV, when we calculate the NPV, we do it based on certain forecasted figures, like cash inflows. Like, for example, we forecast that the investment will be $450,000. We forecast that in year 1, we will have a cash inflow of $500,000. Year 2, we forecast another figure. Okay. So when we are doing this NPV calculation, for example, it will look like this: 500,000 or say 50,000. That will be the investment. Then in year 1, we are expecting to get 20,000. Year 2, we are expecting 25,000. Year 3, we are expecting 30,000. Okay. Now, based on these figures, we calculate an NPV, and if it is positive, we say go ahead, accept the project. Okay. But what you have to understand is this calculation is done today. And we are predicting a cash inflow that is going to happen in 1 year's time, 2 years' time, 3 years' time, sometimes 25 years down the line. Okay. So the thing is, I mean, obviously, we can't, we can't assume that what we forecasted will actually hold true, right? Maybe in year 1, we will make 20,000, but maybe year 2, it will become 27,000. Year 3, suddenly some COVID might come. Then it might become 10,000. Okay. So what we have to do is, we have to see, okay, how is this figure, the cash inflow, how is it affecting the NPV? Okay. For example, if let's say this 20,000 for some reason becomes 10,000, I'm just saying in a future year, it becomes 10,000, and that resulted in the NPV becoming negative. Okay. Then what we have to understand is, now 10,000 means this has reduced by 50%, right? We have to understand that the NPV is sensitive to this cash inflow. Okay. So 50% means it's fine, right? Because it's a big figure. It's unlikely that 20,000 will drop like that to 10,000. But if the sensitivity was like 1%, 2%, that means if this figure, even if it slightly changes, a positive NPV can become a negative NPV. So if there are figures like that, a cash inflow like that, that means you have to be very careful with that figure. You have to make sure that in the years to come, what we predicted actually happens. The things like your selling price, things like your cost, those things and all, we have to make sure that our prediction actually, to a very great extent, it stays as it is. Because if that number changes, then a positive NPV can become a negative NPV and you will end up making a loss. So in sensitivity analysis, what do? We look at different variables like the selling price, the variable costs, okay, the contribution, so many figures. We look at how much should the selling price drop for the NPV to become negative. How much should the variable cost increase for the NPV to become negative? So we just get an idea as to, how careful we should be with that particular variable. So that is sensitivity analysis. But there is obviously a big disadvantage with sensitivity analysis, and that is we can calculate the percentage, okay, this 50% or 10%, only if one variable changes at a time. So when we are calculating the sensitivity of NPV to selling price, we assume that variable cost contribution, everything is constant. But in real life, selling price also can change, variable cost also can change. Like many things can change at the same time. So in that situation, we can't really use this sensitivity analysis. That situation, there is another one that we can opt for. It's called a simulation. It's called a simulation. Now, good news for you is you don't have to know how to calculate any of this. You don't need to know how to get the percentages or anything. You just have to understand what it is and understand that using a spreadsheet makes sensitivity analysis easier to calculate. So if you know that, That's all you need for MA. You will look at sensitivity analysis in detail in your FM paper. Okay, in the skills level, the FM paper, you will look at this in detail. So the point is, they're saying it facilitates what if analysis. That's true. Okay. They allow data to be displayed graphically. That's also true. If you want, you can put graphs, you can put a picture, whatever you want, you can include in the spreadsheet. They allow the font size and color of the text to be changed. Obviously, you can do that in a spreadsheet. You might be wondering, why are they mentioning that as a point? Think about it. If you are writing accounts, you can't do that. Okay, you have to probably take a highlight or something. And, we don't even think about it these days. But back in the day, that was the drill, right? They had to change the color of the pen, underline, all of those things. Things have become a lot easier with spreadsheets. Right. Let's look at the next one. It's to do with variances. So I will give you about 5 minutes to read it and see if you can figure it out. Okay, because we spent an entire day talking about variances. See if you can get the answer. I'll read out the question first. It says, JKB company budgeted to sell 5,000 units of a product in November at a standard price of 30 per unit and to earn a profit of 25,000. So first, profit now they're talking about. So this is obviously absorption costing. If it was marginal, they would use the word contribution. It actually sold 6,000 units at $28 per unit and earned a profit of 32,000. What was the favorable sales volume profit variance for November? So if you were here last week, I gave you all the equations that you need to calculate all the variances. So sales volume profit variance, it will be under the heading called sales variances. Okay, so have a look back at your notes, see if you can figure out how to get this sales volume profit variance. Okay, so let's hope you have figured out the equations. Let me give it to you. So they are asking for the sales volume profit variance. So if you remember, it looked like this. Well, actual at standard and standard. And I told you the sales variance, this actual at standard, by default, it is divided into 2. Okay. And the answer, the difference between these two figures, that will give you the sales price variance. But that's not what they are asking, so we don't have to worry about this. What they are asking for is the volume profit margin. That's what they're asking. So what was the equation for that? It is the actual quantity into the standard profit. And here it will be the budgeted quantity into standard profit. So if you can figure out these 4 pieces, not even 4, it's 3 pieces of information, That will be enough for you to calculate the volume profit margin. So let's read the question. It says they budgeted to sell 5,000 units. So we have budgeted quantity now. So let's put that there first. So that's 5,000. In November, at a standard price of 30 per unit and to earn a profit of 25,000. So we have the total profit and the standard price as well. So if we divide 25,000 by the number of units that we budgeted to sell, then we can get the standard profit, because for the entire 5,000 that we budgeted, we are assuming that we will earn profit of 25,000. Okay. Right. So to get this standard profit, what do we have to do? Standard profit equals to the total profit for 5,000 units is 25,000. Divide that by the number of units that we budgeted, okay? Because this is a standard profit, remember? So you have to divide it by the budgeted figure, 5,000. So that will be 5. So standard profit will be 5 on both sides. And let's see if we can get the actual quantity. It actually sold 6,000 units at 28 per unit and earned a profit of 32,000. So we don't need all of that information. We just need the actual quantity that they sold, which is 6,000. Right. So 6,000 into 5, that will give you 30,000. And 5,000 into 5 will give you 25,000. The difference is 5,000. Okay. The question is already telling us that it's a favorable variance. But anyways, let's just check. Look, this is the standard box. Okay. So we are supposed to get 25,000. It's a sales variance. So we're supposed to get 25,000. We have got more. We have got 30,000. Meaning we have got 5,000 more. Getting more is always a good thing. So this is a favorable variance. Answer will be 5,000. Okay, so you can take that down. There's a small lag, I feel. So let me see if I can use a workbook instead. Yeah, let's do this. Okay, so let's look at the next question. It says, which of the following are benefits of using activity-based costing? All right. So let me quickly give you a brief recap of activity-based costing. Okay, so we also call it ABC. We also call it ABC. So what is ABC? Why have we, introduced this into our costing system? Why are we calling it a new costing technique? Okay. So to understand ABC properly, first you have to understand absorption costing properly. So let me explain what absorption costing is. So in absorption costing, what we try to do is we have an overhead cost. Okay. So what is that overhead cost? It could be things like your rent, your electricity bill, okay, any security guard salary. Okay. So any cost that you will incur, which is not directly attributable to your production. So it's not directly happening with your cost units, but it is external. Okay. So these rent, electricity, security guard salary, what we do in absorption costing is we add them all together. Okay. We add them all together and we get a total overhead cost. Okay. We get a total overhead cost. And then what we do, we divide this total overhead cost by what we call an appropriate base. Okay. So that can either be the number of units or the activity level, the number of units that you produce, or more commonly it can be labor hours. or it can be machine hours. So whatever we feel where, it makes more sense, whatever base we feel makes more sense, we can divide this overhead cost with that. So let's say, for example, in our factory, we have a lot of labor hours. So there are, laborers who are making our product, and in terms of labor hours, it's a huge quantity. So then instead of using activity or machine hours, we can go ahead and use labor hours as the base. Then what do? We take this total overhead cost. Okay, we take the total overhead cost and we divide it by the total labor hours. And the answer, we call it an overhead absorption rate or an OAR. Okay. Now, this OAR, we can incorporate it into the cost of the product. So, how do we do that? When it comes to our cost card, we will have direct material, direct labor, then we might have variable overheads. And when we are talking about the fixed overheads, what we do is we take the OAR, let's say that was $2 per hour. We take the 2 and we multiply it by the number of labor hours that we use per unit. So they say the number of labor hours was 4 hours per unit. We take 2 multiplied by 4. So this is absorption costing, normal absorption costing. ABC is like absorption costing, but only slightly different. So let me explain how ABC works. Now these same overheads, okay, these same overheads, let's have it here. And now when it comes to ABC, let's assume this rent, electricity, security guards have significant quantity. Back in the day with traditional manufacturing, only direct labor was, a significant quantity. But now because we are having machines and, we are doing things like just in time and stuff, for us in our current modern manufacturing, what find is the overheads are a significant cost. Okay, it's a significant cost. So now we don't want to make the mistake of just adding all of this and dividing it by some base and, just randomly putting some figure into the cost unit, because like I said, it is significant now. Back in the day, it was not significant. So this total overheads, it was actually a small figure. Monetarily, it was a small figure. But now when you calculate total overheads, it tends to be more significant because of the way manufacturing has changed. Okay. So what do? Let's assume in our factory, okay, so let's say this is the factory. We had a security guard. And this security guard, let's say we paid him $100 a day. Okay, we paid him $100 a day, but we don't pay him every day. Okay, we pay him only if there are deliveries coming in. Because let's say his job is just to make sure that all the deliveries are, according to the purchase orders, and make sure that all the deliveries are safe inside the factory. So only the days in which there are deliveries, we will call the security guard and pay him the $100. Now, what you have to understand is this security guard's salary, we call it a cost pool. That's the name we give in ABC. This cost pool is driven by something, meaning if the number of deliveries increases, then this cost will also increase because he will have to come more times. If the deliveries reduce, then this cost will also reduce. So the factor that is driving the cost pool, we call it the cost driver. It's a cost driver. Now what happens, very simply, instead of taking a total and dividing it by an appropriate base, we take each of these cost pools separately. So maybe rent separately, electricity separately, the security guard salary separately, and we divide it by an appropriate cost driver. We divide it by something that is actually causing that cost to happen. So in this case, maybe the cost pool, we will divide this 100. Let's say totally we paid him 10,000. 10,000 is too much. Let's say we paid him 1,500 in the month. We divide that by the number of deliveries that came. So let's say there were 10 deliveries that came. Okay, so then we get a cost $150 per delivery. Now what do we do? For your product, okay, let's say it was a table, for example, direct material, direct labor, variable overheads, everything will be according to normal. And when it comes to the fixed overhead, all we have to do is, it was 150, no? So in this case, it won't be OAR and all. It will be $150 per delivery. So let's say for a table, it we had to call delivery 2 times, then it will be 150 into 2. That's how activity-based costing works. Okay. Again, good news, you don't have to know how to do the calculations. I just showed you how it's done. What you have to know is that you take every overhead cost that you incur separately. Okay, you take everything separately. We call each of those costs cost pools. And the cost pool, you will divide it by an appropriate cost driver. Now, the challenge is for every cost, you have to figure out what is driving that cost. That's not easy. Okay, because you will have 100 costs. So each of them you have to find out, okay, which one is going to drive this cost. So it's going to take a lot of time. Okay. Once you find the cost driver, you take the cost pool, divide it with the cost driver, and then using that rate, you can incorporate it into the cost of the unit. So the challenge here is it takes time. So if it takes time, you have to pay somebody to do this. So obviously it's going to be costly. So if you feel that in your business, overheads is not significant, okay, it's not significant, then it's better to go for the traditional absorption costing itself. Okay. Or even if you feel that the overhead is significant, but in your factory, we actually have a lot of labor hours. Okay, we have a lot of labor hours. If you feel like that, then also you can go for absorption costing. You can take the total overheads, divide it by the labor hours, and get the overhead absorption rate and carry on. So the only time when you will think of implementing ABC is if the overhead cost is significant and all the overheads are driven by some other factor other than the traditional labor hours, machine hours, activity levels. Okay, so if you feel that there is a cost that is driven by something else, there are a lot of costs like this, it is a huge quantity in terms of money, then it's better to go for ABC. Okay. Right, so let's look at it and see what the answer will be. It says, which of the following are benefits of using activity-based costing? It recognizes that overhead costs are not always driven by the volume of production. That's true. We know that certain costs, it's not driven by volume of production. For example, the security guard salary was driven by the number of deliveries. Yeah, so 1 is correct. It does not result in under or over absorption of fixed overheads. It does not result in under or over absorption of fixed overheads. Actually speaking, ABC is very similar to absorption costing. Only thing is, instead of taking totals and dividing it by one common base, we take individual overheads and divide it by different bases. But that doesn't mean there won't be a difference between the budget and the actual. So wherever there is a difference between the budget and actual, anyway, this under over absorption problem will come. So 2 is not correct because it can result in under or over absorption. It avoids all arbitrary cost apportionment. So what this means is they are saying, if you are using ABC, we will never divide an overhead cost by something like labor hours. That's not true, because for example, if a particular cost, okay, if a particular overhead, the cost driver for that particular overhead was labor hours, then we are happy to divide it by labor hours. We are not against labor hours, machine hours, and activity levels. We are not. Okay. So if the cost pool is actually driven by labor hours, then by all means we will divide by labor hours. So we won't avoid it entirely. Okay. So 3 is also not correct. It is particularly useful in single product businesses. Not really. Okay, because if it's a single product business, then again, you won't have this many overheads and, different drivers and stuff. Usually this problem happens only when we have more than one product. Because if you have one product, then whatever the overheads you get, even if it's a huge number in terms of quantity, it's a big dollar figure, still you can divide it by the number of products that you make, get an OAR and incorporate into the product. So ABC is only useful if you have more than one product. Okay. So the answer there should be 1 only, A. Okay. So I hope that has cleared ABC for you. Where will you see ABC again? You will see it in a paper called Performance Management. In that paper, you have to know how to do the calculations. 20.12, that's an easy one. They're asking you, using the above figures, what is the best approximation of the internal rate of return of the investment projects? They're asking you to calculate IRR. Okay. So to calculate IRR, you must know that we need to have 2 NPVs. Okay. And you have to have 2 discount rates. You need to have 2 NPVs and 2 discount rates. So here they have given you 3 discount rates and 3 NPVs. Okay. What you have to know, the other thing is, when you're calculating IRR, it's always best practice. Okay, it's always best practice to use 1 positive NPV, okay, and 1 negative NPV. Okay, I'm not saying it's a hard and fast rule. It's good if you do it because the estimate will be more reliable. If you want a reliable estimate, then it's best to go for 1 positive and 1 negative. Okay, so based on that, definitely you'll be choosing 10,500 negative and discount rate of 20% because that's the only negative figure you have. Now, the other decision is, are we going to go for 14% or are we going to go for the 5% discount rate? So, one more thing, best practice is to choose rates that are closest to each other. You choose rates that are closest to each other. So, 20, the rate that is closest to it is 14%. So, it's best to go for 14%. Okay. Right. So we had an equation for IRR. Let me show it, write it down here. So IRR equals A plus the NPV at A divided by the NPV of A minus NPV of B times B minus A. Okay. So what is this A and B story? A is the lower discount rate. NPV is the NPV at the lower discount rate. B is the higher discount rate and NPV-B is the NPV at the higher rate. Okay. So what are the 2 rates we have? We have A, which is the lower rate, 14%. Then we have B, which is the higher rate, which is 20%. And at A, the NPV was 16,000 positive. And at B, it was 10,500 negative. So that's all we need to calculate the IRR. So let's quickly do that. You can try it as well on your own. Always, guys, IRR, when you're putting it in the calculator, don't include the percentage signs. Okay. Right. So A is 14. Okay, 14 plus the NPV at A is 16,000. You divide that by, again, the NPV of A, so that is 16,000, minus, remember, there is a minus in the equation itself. So that's the one I have written here, minus NPV of B. So at B, the NPV was minus 10,500. So that will go in brackets. So it will minus into minus, it will actually become plus. Okay. Times B minus A. So B was the higher rate, which is 20, minus A, which is 40. Okay. So now if you put that in your cal, you should be able to get the IRR. Let me show you how to do it also because I feel I didn't show it in the TRG. So if this is your cal, put 14 plus, open the fraction, 16,000 over 16,000 minus open brackets minus 10,500. Then go to the right times B minus A. So that is 20 minus 14. So notice I'm not putting any of the percentage signs. Okay. And you will get 17.6. Okay. So 17.6% is the IRR. Let's see if we have it. Yes, A. That's how you should do IRR. Okay, so let's move on. The 13th one. A company uses production labor hours to absorb its fixed production overhead. So that is absorption costing. Okay, we take the labor hours, take the production overheads. The overheads, we divide it with the labor hours. A strike by its workforce results in a loss of 30% of the period's budgeted production labor hours. Which of the following variances will occur as a result of the loss in these labor hours? Okay. So to explain what has happened, let me use numbers. Let's say we budgeted that our workers will work for 100 hours for that particular period. Okay. But now because of the strike, we have actually lost 30% of these hours. Okay. So 30% of 100 hours means we are going to lose 30 hours. So finally, the actual hours that we have is only 70 hours. Okay. So that is what has happened. Now let's see which of the following variances will actually occur because of this loss in labor hours. A is saying adverse fixed overhead capacity variance. If you remember, capacity variance talks about whether we got more hours than we budgeted or less hours than we budgeted. So in this case, we budgeted 100 hours, we got less hours. So actually you will have an adverse fixed overhead capacity variance. That seems to be the answer. Let's look at the others as well. Adverse fixed overhead efficiency variance. Efficiency is always about whether your workforce, whether they work faster or slower than budgeted. Here we are not talking about speed. We are talking about hours that were actually lost. So that has to do with capacity and not efficiency. C is saying adverse direct labor efficiency variance. If you have adverse direct labor efficiency, it means your workforce worked slower than what you budgeted. Again, not the case. And adverse direct labor rate variance means you budgeted to spend, let's say, $5. Okay, $5 per hour. Adverse rate means for some reason you ended up paying your workers $7 per hour. You paid more than what you budgeted. They don't talk about anything like that in this question. Okay, so the answer will be A. Right. Now you can look at the 14th one. A firm with current assets of 40 million and current liabilities of 20 million buys 5 million of inventory on credit, which increases its inventory level to 10 million. Okay. What will be the effect on its current ratio and quick ratio? I'll give you a minute. See if you can figure out how to get that answer. They're asking you, because of the 5 million inventory that you bought, what will happen to the current ratio and what will happen to the quick ratio? So to give you a heads up, first you have to calculate current ratio and quick ratio before you bought that 5 million inventory. Then you have to calculate current ratio, quick ratio after you buy the 5 million inventory. Okay, so see if you can figure it out. Okay, so let me start. So before we have inventory, let's calculate the current ratio. Okay, so what is current ratio? It's the current assets divided by the current liabilities. Okay, so let me say this is before. Right, so current assets divided by current liabilities, they're telling us that the current asset is 40 million and the current liabilities is 20 million. Okay, so that is very straightforward. 40 divided by 20. So we will have the current ratio as 2. Okay, so we have the current ratio as 2. I bold this. This is before. Okay, now let's get the quick ratio as well. What is the quick ratio? It's the current assets minus inventory divided by the current liabilities. We have to look. It says, we are buying 5 million worth inventory on credit, which increases its inventory level to 10 million. So that means earlier you had some amount of inventory. When we bought 5 million additional inventory, it became 10 million. So that means how much did we have initially? 10 minus 5, we had 5 million. Okay, so that will be 40 minus 5 divided by the current liabilities is 20 like before. So that will give you the quick ratio as 1.75. Okay. So this is the situation before we got the inventory. Now let's do the same thing after. What happens to current ratio? As always, it's current assets divided by current liabilities. So here, what happens to current assets? It was 40, but now we are getting additional inventory worth 5 million. So you have to add that 5. Divided by current liabilities, it was 20. And because the inventory was bought on credit, okay, because it was bought on credit, the 5 million, you will have to add it. It will become a trade payables. Okay, it would become a trade payables. So 40 plus 5 divided by 20 plus 5, that will give you 1.8. All right, so that's the current ratio after. Now let's look at the quick ratio. Okay, so again, it's the same equation. It's the same equation. Current assets. Now, what will the current assets be? It's going to be 40 plus whatever inventory. Okay, so 40 plus 5, it will become 45 because we got inventory worth 5. So the current assets is going to become 45 minus now our inventory is going to be worth 10 million because we already had 5. We bought 5 additionally, so it's going to become 10. Okay, so 45 minus 10 divided by the current liabilities, which will be 20 plus 5. Okay, so that will give you 1.4. Now, all you have to do is difference between the befores and the afters. Okay, so if you are talking about the current ratio, it was 2 and it has become 1.8. Okay, so if you want to find the percentage difference, we are talking about, let's see how much it will be. The difference is 0.2. You divide it by what it was initially into 100. Okay, so if you are not familiar with this, if you have two numbers and you want to find what is the percentage difference between the two, you have to follow this equation. Okay, it is the final figure minus the initial figure divided by the initial figure into 100. If you follow this, most of the time, this is how you calculate a percentage difference. Okay, might have done this like grade 7, grade 8, but I'm just telling you. Okay. So if you look at the current ratio, the final figure was 1.8. The initial figure was 2. So basically 2. That you divide by the initial figure of 2 and you multiply that by 100 and you will get, let me check. Yeah, you will get 10%. So somebody gave that answer 10%. So what is happening? The current ratio is actually reducing by 10%. Okay, so it reduces by 10%. And let's look at what happens to the quick ratio. We had it was 1.75 and it has become 1.4. So again, it is reducing. The difference between 1.75 and 1.4 is 0.35. Divide that by the initial figure of 1.75 multiplied by 100. You will get 20%. Okay. So this has also reduced by 20%. Okay. So current ratio has reduced by 10% and the quick ratio has reduced by 20%, which is D. Okay. So here you don't have a choice. You have to do the calculations to find out what happened to the two ratios. Right. It says the 15th one, a publishing company is researching the reading habits of the United Kingdom's population. It randomly selects a number of locations from around the UK and then interviews everyone who lives in these locations. What is this approach to sampling known as? What do you think it is? There are different types of sampling. You have to be aware of all of them. They are selecting a number of locations randomly and then we are interviewing everyone who lives in that location. Okay. So let me quickly give you a quick recap of sampling techniques because for some reason your examiner tends to ask questions from that area. Okay, so I don't want to leave that untouched. Let's go to one of my slides. So let me talk about sampling a bit. Sampling techniques. Okay. Right. So first thing you have to understand is there is a reason why we have to do sampling. Okay. Because let's say, for example, we have 100 people. We want to ask them a question. We want to ask them, what's your favorite place to go for a holiday? Just a question. Now, if it was just 100 people, then maybe we can go and ask each and every one of them that question. But if our sample size, I mean, not our sample size, rather our population, if it was like 10 million people, then it is not practical to go to each of them and ask a question. So then what do? We take a sample from this 10 million people and just ask them and we assume that that would be the answer if we asked all of them as well. Okay, so if we go and ask each and every person, what is your favorite spot for vacation? That is called a census. That's called a census. You will see it most likely when in the country they're trying to calculate how many people, what's the population of the country. Then they will come to every house, they will give you a sheet of paper, they will ask you write down everybody's name. Yeah. So then we are not missing out anybody, we are including everyone. That is called a census. But for a business, they won't necessarily need to do a census. It's going to be too costly. So what they can do is instead of asking everybody the question, they can get a sample from this entire population and ask just the sample, whatever question you have. Okay. Now, the thing is, how do we select the sample? That's the question. There are different techniques that you can use. The first one is the simple random sample. Okay. So, in a simple random sample, it's nothing too complicated. It's very simple. You have to know how many people you have. Okay. So, let's say we have 500 people in the population and we want to take a sample of say 10 people. Out of the 500, we want to take a sample of 10 people. So all you have to do when it comes to simple random sampling, let me show you. There is something called a random number generator. Random number generator. So you can go on Google like this. Minimum, it has to be 1. Maximum, we have 500 people, right? And we want a sample of 10. So what we will do is we'll start, giving each of those 500, we will give them a number. So let's say Mr. A is number 1, B is 2, C is 3. Likewise, everybody, we will give them a number and then we will generate a random number. See, it's 468. So now the person who has 468 allocated to him, he is number 1 in the sample. Like this, we will do it 10 times. So the second person will be number 309. Third person will be number 475. Fourth, 231. Fifth, 291. So likewise, when you do it 10 times, you will get a random sample of 10 people out of this 500 people. So you can either do it using a random number generator like this one, or back in the day, we used to have something called a book of random numbers. Okay, so there was a way to choose the random number. Actually, even I have chosen it during my O-levels and all, I used to use it. But nowadays, nobody uses it. I mean, I'm not too old. So even like about 10 years ago, yeah, it's a little old. People used to, look at it. But now it's almost always just the random number generator online. Okay. So that is a simple random sample. Just randomly you have to do it. But the thing is, to do simple random sample, you have to know the population size. So you have to know that there are 500 people and you should be able to give each of them a number. If you don't have that, then you can't obviously do this technique. Okay. So giving each of them a number and having that 500 people, it's called a sampling frame. Okay. We have a numbered list of all the items in the population. If you don't have the sample frame, then you can't use simple random sampling. Then we have another type of sampling called quasi-random. Quasi means it's kind of random, partially random. Okay. There are different techniques that fall under quasi-random. The first one is systematic sampling. So what is systematic sampling? Just like in the simple random sample, you have to have the sample frame. Okay. Now let's say again it was 1 to 500. We just take the random number generator. Let me generate a number 345. Okay. So the person who is number 345, I will call him and tell him he is my first sample. Okay. So 345. We have 345 now to 500. Now what you do, every nth number. So let's say n is 5, you choose whatever the gap you want. Let's say it's 5. Every fifth person will become part of the sample. So 345 is 1. The next one will be 350. The next one will be 355. Then the 360th person. Likewise, we will start choosing samples. All of them will have a gap of 5 between them. So the initial number that you choose, it's random, but thereafter the gap between all the samples will be a fixed number which you can decide. How do you make that decision? Depends on how many people you want in the sample. If you want a lot of people, then have gaps of 5. If you want a smaller sample, then maybe have gaps of 50. Okay, so that is entirely up to you. That is systematic sampling. Then we have another type of sampling called stratified sampling. This is also quasi-random, meaning it's kind of random. Okay, it's meaning quasi means it's some language, I think Latin or something, where it's not random also, it's not systematic also, it's something in the middle. Okay. So what happens here? First, we divide the population into strata. Strata means categories. So the main population, the 500 people that you have, you first divide that into categories. So let's say, for example, of the 500 people, we divide it into men and women. Okay, so let's say 60% of our population was women and 40% of the population was men, I'm just saying. Okay, and now let's say our sample, we want only 10 people in our sample. So in stratified sampling, what we do is we make sure that the sample that we are choosing, it reflects that 60% women and 40% men that was there in the initial population. So 10 people means we will make sure 6 are women and 4 are men. So the original categories and the percentage at which we actually got those two categories in the population, we will make sure the sample also reflects that percentage. That is stratified sampling. Then we have another type called multi-stage sampling. Let's look at it with an example to avoid wasting time. So say, for example, we divide the country into provinces and a random sample of provinces are taken. So if it's in Sri Lanka, for example, we have the western province, the southern province, the northern province. So we have so many provinces. We first call all of them. Okay, then what do? We choose a random sample of provinces. So let's say we chose the western province. So our sample is going to be from the western province. Okay. Each province chosen in step 1 is then subdivided into towns and cities, and a random sample of these are taken. So for example, in the western province, you have different districts, right? So we have, let's say, Colombo. Then we will have Colombo, Gampaha. Okay, so likewise, you have different districts in the western province. Then what do? We take each district and again we start dividing it. So maybe we can go for roads. So in Colombo, maybe we can talk about Gaul Road. Okay. Duplication Road. Okay. So we can divide that particular district into the roads. Then we can go into further detail, and let's say in Duplication Road, we find a bylane somewhere. And what do? We take a sample of, let's say, 5 houses in that lane or 3 houses in that lane, and we go and interview the people in those houses. So why do we call it multi-stage? Because we are taking one big population and we are subdividing it again and again and again until finally we reach our sample. Okay, so that is why it's called multi-stage sampling. Again, it's a type of quasi-random sampling. Then we have non-random sampling, which means it's not random at all. So what is this? One is quota sampling. Quota means simple. You tell the interviewer, interview the first 500 people that you see. So whoever comes, whether it's a beggar or whether it's a CEO, we are not going to do anything. We are not going to filter. Whoever comes, the first 500, we will interview them, and that's it. After that, the 501st person who comes, we are not going to entertain. We will tell him, sorry, that's it. Our quota is over. Quota sampling. Cluster sampling, selecting a definable subsection of a population as the sample. That subsection is taken to be representative of the entire population. So look at this example. Suppose a company has 100 branches issuing sales invoices. Take a random sample of 10 offices and check every invoice in each of these offices. Cluster sampling means it is kind of similar to this one, multi-stage. Okay, but in multi-stage, even at the end, we take a sample of the houses in that lane and only we will interview them. Even the last step, we are taking a sample. But when it comes to cluster sampling, we take 100 branches, we take a random sample of 10. But after we come to the last stage, let it be a house or let it be, in this case, an office. Once we come to the last stage, we, interview or we check every unit in that last step, the last stage. So here, every invoice you're checking, or every house in the street you will interview. Okay, so how do we differentiate cluster sampling from the others? It will look similar to stratified sometimes. It will look similar to multi-stage sometimes. But the defining factor will be that when you're talking about cluster sampling, somewhere in the question, they will say that we interview everybody or everything is checked. So the moment you see that everything is checked, then you will understand that that is cluster sampling. Because whether it be stratified or multi-stage, at the end also, finally, we talk about, a sample. We take a sample and then only interview. But cluster, at the end, the last stage, we will interview everybody. Okay. Those are the different types of sampling you have to know for your exam. Okay. So keep that in mind and let's look at this question. A publishing company is researching the reading habits of the UK's population. It randomly selects a number of locations around the UK, then interviews everyone who lives in these locations. So they are randomly selecting. Okay, maybe they will have London, maybe they will have Birmingham, maybe they will have, different cities. Okay, but after that, finally, they are interviewing everyone who lives in that location. So always remember, when that everyone word comes in, we are always talking about cluster sampling. That's how you differentiate. Okay, so the answer there will be D. All right, so it's 7:10 now. Take a break for 15 minutes. Please be back at 10:15. Yeah, 7:25. Okay, so we will continue from that point onwards. If you have questions, guys, you can always drop it in the chat. Okay, feel free. Okay, we have a minute more. Okay. Okay, so I hope all of you are back. Let's move on to the next question. Okay. So it says here, BR company has a single product with a selling price of 12 per unit. That's the selling price, 12 per unit, which is calculated as variable cost per unit plus 20%. Okay. So the variable cost plus 20% gives you 12 per unit. At an output level of 5,000 units, it makes a loss of $8,000. What is the company's total fixed cost? Okay. So first of all, if you want to calculate fixed cost, you have to calculate the variable cost because the information is only giving us details about variable cost. So what we know is the variable cost plus 20%. That gives us how much? 12 per unit, the selling price. That's how they told us they calculated the selling price. So in other words, as a calculation, how I will write this is the variable cost times 20% increment, no? So into 120%, 100 plus 20% should give me 12. Okay. So the variable cost alone, we are talking about 12 divided by 120%. So 12 divided by 120%, the variable cost is 10, obviously per unit, because selling price was a per unit figure, 12 per unit. Okay. Now, if the variable cost is 10, okay, if the variable cost is 10, and we know that the selling price was 12, right? That's what they say. They say that the selling price is 12. Then we can calculate the fixed cost, which is 12 minus 10, which is how much? $2 per unit. That's the fixed cost. Variable cost is 10, fixed cost is 12. Then they say at an output level of 5,000 units, it's making a loss of 8,000. So first let's calculate how much is that 5,000 units going to be for the fixed cost alone. So 2 per unit into 5,000 units, which is 10,000. Okay, it's 10,000. Now some of you might have the question, okay, why did I deduct the selling price and the variable cost and get the fixed cost? The reason is because I know that this product is loss making, 8,000 loss making. That means this 12 is not giving me any profit as such. Okay, if at all, it's only going to give me the, the additional fixed cost because the variable cost is 10. We are selling for 12, but even though we are selling for 12, we are not getting any profit. So that means that additional $2 is definitely not profit. That is also cost. And since we know that the variable cost is 10, obviously that additional 2, it has to be the fixed cost element. But that's just not it. Okay, in addition to this 10,000, because we are making a loss of 8,000, that also you have to add to 10,000. Okay, so the loss, which is 8,000, you will add it, and the total fixed cost, we call it 18,000. Okay, I'll go through it once more. It's like this. They told me the variable cost plus 20% is how we calculated selling price, $12. Now, usually a cost plus a profit margin or markup only will give the selling price. But here we know that it's only one product. And this one product is making a loss. That means our selling price is actually not including any profit, because if there was a profit, then we would make a profit, not a loss. Okay. So anyway, we forget about that and we calculate the variable cost per unit. So that is 12 divided by 120, which is 10. Now we know that the selling price is 12, and although it is 12, we are not making any profit. So the difference, which is 12 minus 10, 2 per unit, that is also going to be a cost that you are incurring. That is why it's a loss. Okay. So since we know that the variable cost is 10, the only other cost it can be is a fixed cost. So we say the fixed cost is 2 per unit. So for 5,000 units, 5,000 into 2, 10,000 is a fixed cost. But in addition to this, we are making a loss also of 8,000. So that is also a cost, a fixed cost that we are incurring, but we are not incorporating that into the selling price. So that loss of 8,000 also you add, and you get the total fixed cost as 18,000. Right? So that will be C. So it's a little different, right? Usually we don't get a question like this, but in your exam, you can expect 1 or 2 questions to be slightly different, but whatever you need will be given directly in the question itself. To do the question, whatever you need will be given in the question itself. So I'll take this off because I don't want you to get confused. Because if you want a number, if you want to increase it by 20%, you can't just add it by 20%. No, you have to multiply it by 120%. You should know that by now. So that is why this comes in. Okay, so that will be C. Okay, another question entirely based on variance analysis. What are they asking us? The following data are available for product X. We have sales units, sales revenue, manufacturing cost, profit. We have the budgets and the actuals. They're asking you, actually it's 2 questions, right? 17 and 18 are linked. They're asking for the sales price variance and the sales volume profit margin variance. So you can try it. I will just help you out with the equations. But again, for your exam, guys, you have to memorize the equations. Then we have actual at standard. And we have over here standard. Right. So the first one, it will be the actual quantity into the actual price. And the actual at standard column, you should know by now, by default, it's divided into 2. So the first side will be actual quantity into standard price. And here it will be actual quantity into standard profit. Okay. And under the standard column, we will have budgeted quantity into standard profit. Okay. So these are the equations that you will have to use. So have a go, try to pick out the correct information from the question and see if you can get the sales price variance. So let me put price here and the volume profit variance. Give you a second, you can try it, okay? So these two are usually there is a division. So I'll put that as well. When comes the sales variances, by default, there is a division when it comes to the actual at standard. Okay, so let me read the question and see if I can find the information that I want. Okay, right. So first we need actual quantity. Okay, so actual sales quantity. These are the actuals. It's very clearly given here. Sales units are 5,200. Multiplied by actual price. Do we have how much we sold per unit price? In the actuals, we don't have. Okay, so we leave that blank. Here again, they're asking for actual quantity, which is 5,200. The other thing that we have in the question is, okay, we don't have the actual price, but they're telling us that the actual sales revenue, meaning 5,200 into some figure, it will give you 57,200. So they're giving us the total. So we can just put that over here. 57,200. Then let's see if we have the standard price. So if we want, we can get the actual price, right? It's 57,200 divided by 5,200. If you want, you can get that. If you want, let me get it. 57,200 divided by 5,200, that is 11. Okay. Right. So now let's see if they've given me the standard price. Okay. In my standard section, they haven't given me how much per unit the standard price is. But again, like in the actuals, they have given me the total. They've told me that this is 50,000. Okay. So I can just put the total there. And if I want, I can find what the standard price is as well. So that is going to be 50,000 divided by 5,200, which is 9.6, close to 10. Okay. Right. Just say 10. It's not important. So just let's say 10 instead of putting the 9 point odd figure. Okay. Right. So now let's look at the next area, actual quantity. Again, 5,200 into standard profit. Okay. So for standard profit in our question, what do we have? What we have is, one second guys. This one, it was 9 point odd, right? It's not 9 point odd, right? Because it is 50,000 divided by the budget. Budget was 5,000. I'm sorry, I divided by 5,200, which is not correct. So 50,000 divided by 5,000, that will give you 10. Okay, but again, you don't have to worry because anyway, the 50,000 was given to you in the question. Right. So next up, we have the actual quantity and the standard profit. We don't know standard profit. So let's just move to budgeted quantity. If you look at the budgeted quantity, that is 5,000 into the standard profit. Now, how are we going to calculate the standard profit? Okay. So we have the standard profit total as 20,000. So if we want to know the per unit standard profit, it will be 20,000 divided by 5,000. So that is 4. That's the standard profit. 4, and over here also you have to say 4. So in case you want to know, that's 20,000 divided by 5,000. Okay, so 5,200 into 4, that will be 20,800. And 5,000 into 4 will be 20,000. So we have everything that we need to get the variances. Okay. Right. So the difference between 57,200 and 50,000 is, one second, there is a small mismatch. Yes, sorry. Actual quantity into standard price, right? I have put just the budgeted 50,000. I'm so sorry. This is 5,200 into 10, 52,000. Okay, I'm so sorry about that. Okay, so it's the actual quantity, and because this is actual and standard, you can't just use what's in the question. Okay, I just did the same thing that I did for the actuals, which is not the way you do the second column, right? So you have the actual quantity as 52,000. Standard price, this is how I calculated it. It was how much? 50,000, which was the sales revenue. I divided it with the budgeted sales units, which is 5,000. So I got that as 10. Okay, so that will give you 52,000. So sorry about that, guys. Okay. Right, so 57,200 minus 52,000 will give you 5,200. That's the price variance. We'll decide if this is adverse or favorable in a bit. Okay. Then 20,800 minus 20,000, the difference is 800. Again, let's decide if this is adverse or favorable in a minute. Okay. Right. So if you look at 52,000, it has a little bit of standard. Whereas 57,200 is entirely actual. So this is what we expected to get. It's a little bit of standard, no? So that's the budget. So according to my budget, I expected to get 52,000, but I have got more. I have got 57,000. Getting more is a good thing. So I will call this a favorable variance. Okay, so I'll write it favorable. Now this one, the standard box has everything budgeted figures, but here there is a little bit of actual quantity is there. Okay, so this is the budget, this is the actual. I expected to get 20,000 according to my budget. I have got more. I have got 800 more. Getting more is always a good thing. So this is also favorable. Okay, so the price and the volume profit you have. Sales price is 5,200 favorable, which is C. And sales volume profit margin is 800 favorable, which is A. Okay, that's how you get it. So what's important is that you can remember these equations. Give you a minute, you can take it down. Oops. Let's put this here to show that this is in the middle. Yeah. Right, so that is how you do the sales variances. I hope you're comfortable with that. Okay, so today itself we have done 2 variances to do with sales. And let's look at the 19th one. SJC company has used linear regression analysis to establish the relationship between total cost and activity in units. What does the slope of the regression line represent? What does the slope represent? So slope means we're talking about the gradient. I spoke about this on the very first day, if I'm not mistaken. Okay. So let me quickly go through this. You know, in mathematics, there is an equation called y equals mx plus c. Okay, I went through this. So if you're not sure, then please refer the first or second TRG. One of those 2 days, I went through this in detail. Okay, I'm just briefing it now. So there is an equation called y equals mx plus c. Okay, m, we call it the gradient. So that is the y coordinate divided by the x coordinate. That is the gradient. And c, we call it the intercept on the y-axis. Intercept on the y-axis means the point where the line crosses the y-axis, where it touches the y-axis. Okay, and y and x are basically the y coordinate and the x coordinate. So y is the vertical axis, x is the horizontal axis. Okay, now this same concept, we change it a little. We change the letters and we change the position. That's all we do. We call it y equals a plus bx. Okay. And a, what we call, instead of the c only, we have made it a. And instead of putting it at the back of the equation, we have brought it in front. Simple. So a is where the line touches the y-axis, and that is usually the fixed cost. The fixed cost. Okay. And b, it is the slope or the gradient, and that is usually the variable cost per unit. Okay. So here they are asking you, what does the slope of the regression line represent? It is always the variable cost per unit. Okay. So if you're not sure why this happened and why we call it, why the slope is the variable cost, then please refer the first two TRGs. I did go through all of this. Okay. Right. Now we move on to one of the last chapters of your syllabus, and it's called performance measurement. Okay. And this is, to be specific, we're talking about divisional performance measurement. So it says here, a division has a capital employed of 2 million and earns an operating profit of 600,000. It is considering a project that will increase operating profit by 20,000 but would increase its capital employed by 80,000. Meaning, another project, you have to invest 80,000, that will give you a profit of 20,000. A rate of 15% is used to compute interest on capital employed. What will be the effect on residual income and return on capital employed if the division accepts the project? So they're asking you what will happen to the residual income and on the return on capital employed if the division accepts the project. Now what you have to do, simply calculate the residual income and the return on capital employed. Now, return on capital employed for a division. Now, if it's an entire company, it's called ROCE, return on capital employed. But if it is a division, then there is another word. We call it the return on investment, ROI. Okay. So, what you have to do is calculate RI and ROI before the investment and after the investment and see how it has changed. Okay. Right. So, I'll do the current first, and then you will obviously have the equations and you can try the one after the investment. So currently, what is the RI? Okay. So RI has an equation where it goes like this. Let me show you the equations quickly. These are ROI, RI is a little important, so that's why I want to show you the equations. This is ROI. Let's paste it here. And it's not given to you also at your exam, okay? So you have to know it. This is ROI and RI is this. So using these two equations, you have to calculate both the ratios before the investment and after the investment. Okay. So let's do that now. So if you're going to get RI, you can look at the equation. It says the controllable profit. So RI equals to controllable profit. Let's see. Division has a capital employed of 2 million and earns an operating profit of 600,000. So currently the profit is 600,000. $600,000 minus the controllable investment. So what is the controllable investment? Let's see. So for them, before we, invest in the new project, the capital that we have employed or the amount that we have invested is 2 million. Okay, so that will be 2 million multiplied by the cost of capital. So they're saying a rate of 15% is used to compute interest on capital employed. So the cost of capital, we can consider it to be 15%. Okay. So when you put that in your cal, 600,000 minus 2 million into 15%, you will get the RI as 300,000. 300,000, that's the RI, current RI. Now let's do the ROI, return on investment. So remember, return on investment is the word we give for the return on capital employed if it is a division. Okay. So controllable divisional profit, which is 600,000, divided by the divisional capital employed, which we know before the investment was 2 million. You multiply this by 100. Okay, so 600,000 divided by 2 million into 100, we get the ROI as 30%. So we have the RI as 300,000. It's given as a monetary figure like this. And the ROI is given as a percentage always, which is 30%. Those are the current figures. Okay. Now let's do it after the investment. After. What is the RI going to be? Okay. Now, if we invest, they are saying it will increase our operating profit by 20,000. So currently we have an operating profit of 600,000. If we invest in this new project, then we will make extra 20,000. So ultimately the total controllable profit will be 620,000. Okay, that minus the controllable investment. So earlier it was 2 million, but now what's going to happen? It's going to increase by another 80,000. So the investment will be 2,080,000. Okay. Cost of capital is the same, 15%. Now you can get the RI, which is 308,000. Okay. Now same thing. Let's quickly get the ROI as well. So ROI is the controllable divisional profit. So this time the controllable divisional profit is 600,000 plus 20,000, 620,000. You divide that by the divisional capital employed, which is 2,080,000. And it's always given as a percentage, 100%. So that will be 29.8%. Okay. Now let's see what happened to RI. RI was 300,000, it became 308,000, so it has increased. ROI was 30%, it became 29.9, so it has decreased. So RI has increased. Let's write it here. This one has increased. And this one, ROI, it has decreased. Okay. So increase is 1 and decrease, so the answer is B. Okay. What is challenging is you have to know these equations, okay? Because usually ROI, RI, we don't do it. Even in your A levels or something, you would not have seen it. Whereas other things like current assets, current liabilities, quick ratio, the current ratio, all of that you will know. These two you might not have seen before, that's all. Right, so hope that is taken down. Let's try the next mixed bank, which is mixed bank 3, okay? The other thing, guys, I wanted to mention, there are certain questions while I'm doing the TRG itself. I will tell you if it is not in the syllabus, okay? Because there was a small change in September last year. So there is one area that was completely removed. So when there is a question like that, I will mention it to you, okay? Because I haven't updated these questions. So it includes a very small area of the old syllabus. So if that question comes, I will mention that. You don't have to know how to do that. Okay, same thing, even if you have gone for lectures before September or, in October, that time, because the change happened in September. So in October also, we were not sure because, sometimes you might get a question or two. But if you did a lecture during that time, then make sure that process costing, there was a small change. What is that change? I'll tell you that as well. We have completely scrapped off equivalent units. Okay, so I'll show you how the process costing now. My slide, it usually looks like this now. I'll quickly show you that. So all of this is the same. When it comes to process costing, we give an introduction. We talk about normal losses. We talk about normal losses with scrap. We talk about abnormal losses, abnormal gains, and that's it. We don't talk about equivalent units, how many percentage was completed in one process to the other. All of those things we have completely scrapped off. So from process costing, you just have to know normal losses, abnormal gains. That's it. Okay, because if you can remember, there used to be a question like this, right? Materials, 50% was completed in the previous period, and another 50% is going to be completed in this period. Labor, 100% was completed in the previous period. So that kind of percentages and all used to come in questions. Completely scrapped off. Don't worry about it. Okay? Right. Okay, so it says here, LC company wishes to carry out a national survey of adults' reading habits. When you see the word survey itself, you should know they're going to talk about some sampling technique. Okay. To reduce traveling costs, the country was divided into constituencies. Okay, so there are different states or something like that. So they're dividing the country. A sample of 50 constituencies was selected at random. With each of these constituencies, 5 polling districts were selected, again using random techniques. Interviewers will visit a random selection of 30 people on the electoral register of each district selected. So we are taking the country, we are dividing that into constituencies, then into polling districts, and then even in the electoral register, we are only going to take a sample of 30. What do you think? What sampling method is the company using? What do you think? Let's go through it one by one. Stratified. Stratified means at the beginning, when we have the population, we will divide them into categories. And then we will make sure that in our sample, we reflect the percentages that happened in the initial population. So this is not talking about stratified at all. Definitely not. Okay. Systematic means what? We will start numbering all the people. Using a random number generator, we will find out what the starting point is. Then every nth item, we will include it in our sample. Again, it's not described here. C is saying multi-stage. Looks like it because we are taking a country, dividing it into constituencies, then again dividing into polling districts, and then finally using a sample. If it was cluster sampling, then in the electoral register, we will start interviewing everybody. But they are not saying that. Even at the end, we are going to use a random selection. So that is why this will fall under multi-stage. Simple random also, you will have all the people, give them a number, use a random number generator and choose people. So that is exactly what simple random is. They are not talking about it here. The answer here will be C. Okay. Right. When opening inventories were 8,500 liters, and closing inventories were 7,100 liters, William Company had a profit of 61,000 using marginal costing. If the fixed overhead absorption rate was 4 per liter, what was the profit using absorption costing? I told you, they like to ask this. I told you this, I think, in the first 2 classes. They always like to ask this question where they give you the profit in absorption costing and they ask you, if you had used marginal, what will the profit be? So they are saying, we had a profit of 61,000 using marginal. They can ask the other way around as well. So here they are asking you, marginal, the profit was 61,000. What is the profit using absorption costing? Okay. Okay, I'll give you 2 minutes. If you know it, it's an easy 2 marks. If you don't know it, you will never be able to get it. This is that kind of a question. Okay, so I'll give you 2 minutes. I spoke about this a lot in the first 2 classes. So yeah, I'll give you a minute or 2. See if you can remember. The question is, marginal is 61 means what is absorption? Okay, so how do we do this? It is, I told you, the difference between absorption costing and marginal costing only happens because of the way we value closing inventory. Okay, so how do we get the difference? There was a formula which is difference equals to the change in inventory multiplied by the overhead absorption rate. Okay, the change in inventory multiplied by the overhead absorption rate. You have to know this equation. Okay, so they tell us here that opening inventories was 8,500 and closing was 7,100. So the difference is 1,400. Okay, 1,400 into the OAR, they're telling me fixed overhead absorption rate was 4 per liter. So that is 4. So 1,400 into 4, the difference between absorption costing and marginal costing will be 5,600. That's the difference. Now the question is absorption costing 5,600 more than 61,000 or is it 5,600 less than 61,000? Okay, because think about it. If you want a difference of 5,600, it can either be 61,000 plus 5,600. It can either be 66,600. That's also a difference of 5,600. Or it can be 61,000 minus 5,600. 55,400. Now the question is, which one is the answer? Is it 66,600 or is it 55,400? So how do we decide on that? It's like this. You have to see the opening inventory and the closing inventory. Okay. If the inventory increased, then absorption gives the higher profit. Okay. If inventory reduced, then marginal gives the higher profit. So let's see here. Opening inventory was 8,500, closing is 7,100. So what has happened? Inventory has reduced. That means marginal has to give the higher profit. So if marginal is going to give you the higher profit, then it can't be 66,600 because then absorption is higher. It has to be 55,400. So the answer will be this one. B. It can't be this. Sorry. It is 55,400. That's how you get absorption costing profit if you have the marginal costing profit. So sometimes they will ask you to calculate this OAR. How do you do that? Take the budgeted production overheads divided by maybe the budgeted activity level. Okay, so if you do that, you get the OAR. Here it is directly given to you. Right. So it says in the next one, the third one, copy company rents a photocopier with the following charges. A fixed rental amount is payable up to a certain number of copies each period. If the number of copies exceeds this amount, a constant charge per copy is made for all subsequent copies during that period. Which of the following depicts the total photocopier rental cost described? So what they're saying is, maybe 100 copies, you can take it at a fixed rate. Okay, you can take it at a fixed rate. But after that, every copy that you take, you will have to pay an additional amount per copy. So maybe $1 per copy. So it will keep on increasing. Okay. So if you look at graph A, what it's showing is maybe the first 100 copies you're paying, say, $1,000. Then it's saying the cost is stepping up and then for the next maybe 100, you will pay another $1,000. But that's not the case. Because in this question, they are saying, we pay a particular amount up to say 100 copies. After that, the amount that we pay depends on every copy. So it is not a step up like this. It should be a line because as the number of copies increases, the cost will also increase. Here it's saying that for different blocks, we will have to pay an additional cost, which is not the case. Okay. What is graph B saying? It's saying up to a particular level, you will have to pay a fixed amount per unit. So let's say up to 100 units of copies you're taking, you will have to keep on paying $1. But after that, from the 100th copy onwards, you will have to just, you won't pay anything extra. It will be a flat rate. Again, that's not what it's explaining. Graph C is saying up to a specific number of units, we will pay one cost. But after that, whatever units that you take, it will keep on increasing depending on the activity, depending on how many copies that you take. So that is what the question is saying. The answer is graph C. Okay. Right. Graph D also, let me just go through it. It's saying even if you take 100 copies, for example, you won't have to pay anything, but only after the 100th copy, you start paying a dollar figure per copy, which is not the case. Yeah, because the first few copies, you pay a fixed level. Thereafter, the cost increases. You are never given a free copy in this case. So, can't be graph D. Okay. 21.4. The following data relate to the overhead expenditure of an organization at two activity levels. Okay. We have square meters, which is 12,750. And if you're going to, they're not telling us what it is, right? So maybe this is like a cleaning cost or something. So it's like if you clean 12,750 square meters of the office, you will end up paying 73,950 to the cleaning person. And if you clean 15,100, then you might pay 83,585 overhead cost. What is the estimated overhead expenditure if 16,200 square meters are to be cleaned? So we know that from our experience, we know that if you clean 12,750 square meters, they will charge you 73,950. Again, based on our experience, if we clean 15,100, they will charge us 83,585. Now they are asking me to predict. They are asking me, if we were to clean 16,200, we don't know because we haven't done it in the past. They are asking, if it was 16,200, how much will we incur as a cost? How much will we incur as a cost? So when you look at it itself, you have to understand that you have to do the high-low method. Okay. So I'll give you 5 minutes and then I will do the high-low method. See if you can get the answer. Okay. High-low method. See, this is easy. Okay. It's not a complicated thing. So try. You should be able to get the hang of it. Take your time. If you have questions, you can ask. Because now see, by the time we are done with this TRG, you should be confident at attempting questions, right? That is the first step. Okay, you should first of all have the confidence to start a question. Only if you have the confidence to start will, either it will be right, but even if it's wrong, you have something to learn. If you're going to look at it and you don't know where to start, then that on its own is a problem. So first, build up the confidence to do the question. Don't be afraid if it's wrong, okay? Because at least you saw the question not into your exam. You saw it before. So you have the chance to correct it, okay? So always try to start something. It will help. Once you start writing something, it will definitely help. Don't ever, look at a question and then wonder, okay, where do I start? Just write something. Things will fall into place one by one, okay? Okay. So what you should know is high-low method, always it's good to remember the format. What is the format? You will have activity and you will have cost. And then on this side, it will be the high and the low. So if you know this format and you write it, that will itself help you with the question. Okay. We only have two figures, so nothing to worry about. We have to look at the high and low activity levels, right? Not cost. Okay, the cost may be high, it may be low. We don't care about it. We just look at the high and low activity levels. So the highest activity level is 15,100 and the associated cost was 83,585. Okay, and the lower activity level was 12,750 and the associated cost at that activity level was 73,950. Okay, so that's the first step. Second step is you have to find the difference between the activities and the cost. Okay, so 15,100 minus 12,750, you get 2,350 as the difference. And here 83,585 minus 73,950, you get the difference as 9,635. Okay, that's the first two steps of high-low method. Then the third step is to calculate the variable cost. Cost per unit. Okay. Now variable cost per unit, always remember it's the difference in the cost, which is 9,635. You divide it by the difference in activity, which is 2,350. Okay. So yeah, 9,635, you divide it by 2,350. This divided by this. So the variable cost per unit is $4.1 per unit. Okay, so we have got the variable cost. Now, next what we have to do is we have to find the fixed cost. How do we do that? There is an equation that goes like this. Total cost equals the fixed cost plus the variable cost per unit into the output or the activity. Let me say activity in this case. This is an equation that you have to know. Okay. Now you can either substitute the high or the low. So let me just substitute the high. Both will give you the same answer. So at the high, the activity was how much? 15,100. Total cost was, sorry, activity was 15,100. The total cost was 83,585. Okay, so that should equal to the fixed cost, which is, we don't know, we have to calculate it, plus the variable cost per unit, we calculated it was 4.1, into the activity at the high was 15,100. Okay, 15,100. So now you can rearrange the equation to find the fixed cost. So 83,585. This is plus 4.1 into 15,100. Now, when you bring it to the other side of the equal sign, it's minus. So minus 4.1 into 15,100 should give you the fixed cost. So finally, when you put that in your cal, you should get the fixed cost, which is 21,675. So we have the variable cost per unit. Let me highlight it. And the fixed cost also. So now the question is asking me what? They are asking me what will the total cost be, overhead expenditure, if we are going to clean 16,200 square meters. So now we use the same equation. Okay. But this time we are going to calculate the total cost. So total cost equals to fixed cost, which we know it's 21,675, plus the variable cost per unit, we know it was 4.1, into the activity that they are asking us to do it for is 16,200. Okay. So when you put that in your calculator, you will get the total cost as, let me check, 88,095. Okay, so that is C. Simple. This is the simplest form of high-low method. So if you didn't know how to use these, these tables and, this structure, then definitely you will find yourself stuck. Okay. But if you knew it, then this is going to be simple, easy 2 marks for you. Right. So I'll give you a minute. If you want, you can take this down. If you don't know it, then please take it down. This is only the format that you have to use whenever you have high-low method. Okay, so let's move on to the next one. I'll leave it until I read it. It says, a management consultancy recovers overheads on the basis of chargeable consulting hours. That means the total overheads we divide it by the chargeable consulting hours. Then we get the OAR. Budgeted overheads were 615,000 and actual consulting hours were 32,150. Overheads were under recovered by 35,000. If the actual overheads were 694,075, what was the budgeted overhead absorption rate per hour? Now again, I'll spend some time here because this also is another area where you always tend to get questions. Okay, so let me quickly take you to the slide. That is chapter 5 and 6. These are all your Kaplan chapters, okay? So it will always match if you have the study text, my slides, and that will match with each other. So let me talk about this under absorption story, okay? Okay. So let me explain, again, let me explain absorption costing to you, okay? So how absorption costing works is, we have a total overhead. Okay, we have a total overhead that we have budgeted. Remember, we have budgeted this overhead. We divide that with an appropriate base. So the budgeted may be labor hours. Okay, and that's how we calculate the overhead absorption rate. Now, what you have to understand is the overhead absorption rate is entirely based on budgeted figures, the budgeted overheads and budgeted labor hours. Okay. But when we are absorbing the overhead into the cost unit, when we are doing the absorption, watch carefully. We will put direct material, direct labor, variable overheads. We come to fixed overheads. And how we do the absorption is we take the actual labor hours and we multiply that with the OAR. Remember, this is the absorption part. Okay, so what do? We take the actual labor hours and we multiply it with the OAR, which is a budgeted figure. And then we have the amount that we have absorbed into the cost of the unit. Now, the problem is, in case this budgeted overheads and the actual overheads that we incurred, if it changed, okay, if that changed, that means the amount that we absorbed will be different to the actual amount that you incurred. Okay, so let me just put figures here to make things clear. Okay, let's just say the budgeted total overheads was 100,000. Let's say the budgeted labor hours was 10,000. Okay, so the OIR is 10 per labor hour. Then when we are absorbing it into the unit, we will use the 10. Actual labor hours, let's say it became a little higher. It was 12,000. Oh, sorry, we need the per unit. No, so let's just say it was 12. This will become 120. Now, that's not the problem. Okay. Now, the problem is, suppose the actual overheads, total actual overheads incurred, let's say it became 120,000. For some reason, it increased. Okay, it increased, it became 120,000. Then the problem is, the amount that we have absorbed, we are reflecting the actual labor hours. So that's fine. No problem. Even if the budgeted labor hours was different and actual labor hours are different, it's fine. Because in the absorption, we have taken into account the actual labor hours only. But the OAR, it takes into account the budgeted overheads as well. So the budgeted overheads, if it was not, the actual overheads, if it was not the 100,000 that you budgeted, then the amount that you have absorbed, it will not be the same as the actual overhead. There will be a mismatch. Because remember, the labor hours problem is sorted because when we are doing absorption itself, we are using actual figures. But the budgeted overheads being different, we haven't sorted it out because the actual is something else, but we are using the OAR. OAR only has budgeted overhead rates. So the actual overheads and the absorbed overhead, there will be a mismatch. So sometimes we would have absorbed more than the actual. Then we call it an overabsorption. Sometimes we would have absorbed less. Then we call it an underabsorption. Okay, so this is an area that you have to understand. Okay. So here they teach you how to calculate an under or over absorption. We say it's a 3-step procedure. First thing is calculate the OAR based on the budget. Okay, then calculate the overhead absorbed by actual activity. So that is the OAR into actual level of activity. See, that's what we have done here. So first we got the OAR, then we got the OAR times the actual activity level or labor hours or whatever actual figure. That's the amount that we have absorbed. Now you have to compare the absorbed overhead to the actual overhead that you incurred. And if you absorbed more, we call it an overabsorption. If you absorb less, we call it an underabsorption. Okay, important. It's a small area, but there is a very good, 90% of the papers you will see that they somehow question this in some way. Okay, right. So let's go to this particular question. What does it say? A management consultancy recovers overheads on the basis of chargeable consulting hours. So that's the base. Budgeted overheads were 615,000. So let me write that. The budgeted overheads, that was 615,000. Great. Actual consulting hours was 32,150. So actual hours is 32,150. And we are getting the answer. They're telling us that there is an under absorption. Okay, they are not asking us to calculate whether it's under or over. They're telling us there was an under absorption of 35,000. And they're telling us finally, actual overheads that you actually incurred was 694,075. Okay. Now, what you have to understand is, when calculating under absorption, we will compare the actual overheads, which is this figure, with the budgeted, sorry, with the actual overhead with the absorbed overhead. Okay, so let me highlight this. We will compare actual overhead with the absorbed overhead. Now, the thing is, in this question, we don't have the absorbed overhead. They are asking us what is the budgeted overhead absorption rate per hour. Okay. So to make things easier, let me just bring this down. We compare actual with absorbed, and that only will give you whether it's an under absorption or a over absorption. Yeah. When we compare the actual with the absorbed overhead only, we will decide, okay, is it an under absorption or an over absorption? Now, under absorption means we have absorbed less. So, we have absorbed 35,000 less than 694,075. Okay, so how much have we absorbed? Let's check. This one minus 35,000. So, the actual absorbed amount is 659,075. Now, that is not the answer they are asking. They are not asking how much did you absorb. They are asking you what is the overhead absorption rate, what is the OAR. How do we get that? We know that absorbed overhead, we calculate it how? Actual hours into the OAR. Actual hours into the OAR, that's the way we calculate the absorbed overhead. Okay. So, here we know that the answer to this, actual hours into OAR, the answer to that, we know it is 659,075. Okay, we know that because it's the absorbed overhead. The answer is there. And we also know that actual hours is 32,150. So, 32,150 into the OAR should give you 659,075. Very clearly we know that. So, if we want to calculate OAR, we are talking about divide both sides by 32,150. So, 659,075 divided by 32,150. So, the OAR will be 20.50. So, the answer is B. Okay. So, this over absorption, under absorption, they can ask many questions. Okay. So, this is one where they give you the under absorption. They make you work backwards, get the absorbed overhead, and then they can ask you either the OAR or actual hours. They will give you one and ask for the other. One thing. Or they can give you the actual overheads, make you calculate overhead absorbed, and then decide is it under absorption or over absorption. Or sometimes they can give you the under absorption, the absorbed overhead, and then ask you what is the actual overhead. Okay, so they can make you work backwards. They can, ask for anything within these 4 figures. Okay, so you have to be good at working backwards and figuring out what they're asking. So to make it easier for you, I'm telling you, actual overhead will always be one figure. There is no way to calculate it. Absorbed overhead, there is an equation. It's the actual hours into the OAR. Under absorption also, there is no equation. You have to compare these two and only get. But one more equation we didn't use here is the OAR. OAR is the budgeted overheads divided by the budgeted hours. Okay, we did not use it in this question. But sometimes, now had they given us the budgeted hours, now here they didn't give it to us. They only gave actual. So let's say they gave the budgeted hours as something. Then to get OAR, we don't have to work so much. We can just take this budgeted overhead, 615,000, divided by the budgeted hours. It would have given us the OAR. Okay. Right. Okay, it's an easy question. A pet food company incurred the following costs last year for each of its 3 different markets: dog food, cat food, food supplements. If a pie chart were used to represent the proportion of costs incurred by each area, what would be the angle of the section representing cat food? It's an easy one. You must have been doing this forever. What is the angle of the section representing cat food? This is how do we draw a pie chart, basically. Okay, so let me try. How do we get the angle? Okay, so let me just put all the figures here first so I can use the spreadsheet itself. Dog food is 1,345,000. Then we have cat food, which is 2,300,000. And we have food supplements, which is 985,000. So if you want to know what will be the angle of, what did they ask? Cat food in a pie chart, then you have to take the 2,300,000 divided by the total. Okay, so what's the total here? Okay, so that is 4,630,000. That's the total. So you have to take the cat food divided by the total and multiply it by 360 degrees because the circle has 360 degrees. So angle of cat food or section representing cat food. That will be 2,300,000 divided by 4,630 into 360. Okay, so let me get that answer. Cat divided by the total. This one multiplied by 360. So that will be 178.833. So that is 179. If you remove all the decimals, 179 degrees. So that is A. Simple. All right. So we are talking about a spreadsheet again. So it says here, the following extract from a spreadsheet represents monthly regional sales figures. So product A in the first quarter of the year. Okay. So what they're trying to say is we have a product A. In January, we sold 135,000 of that product in the south. And in the south again in February, how much we sold, in March, how much we sold, and the total. And for all areas of the country, we have put the figures. Which formula would be used to calculate total sales in the West? Okay, so this is this 57,000. They want to know how to calculate it. What do you think? This is simple. So I'll use, since the spreadsheet is here, I'll show you. West, how much is it? 23,000, 19,000, 15,000. Okay, which was 57,000. So the formula, the correct formula that we use is, we put the equal sign. We have to write sum, open brackets, and choose the 3 and press the equal sign. You will get 57,000. Okay, so let's see where we have that. Look at the formula. So we are talking about equal sign and sum. So, okay, straightforward. It can't be C, guys, because there is no equal sign. The equal sign has to be there. So equal sign sum B6. So B6 to D6. Fine. That will only give you 57,000. That will be A. Get easy questions like this as well. Right. Which two of the following statements relating to activity-based costing are true? Okay, so I explained activity-based costing. They're asking which two of this is true. So it's saying the first one, activity-based costs can be used to identify relevant costs for decision making. Relevant costs for decision making. We don't talk about relevant costs when it comes to activity-based costing. Okay, they're two completely different areas. So it can't be that. What is a relevant cost? You should know it, right? So relevant cost, I'll just talk about it also. When you're going to make an investment decision, the cost that you're taking into consideration, they have to be relevant. That means they have to be future, incremental, cash flows. It has to be a cost that you incur in the future. Incremental means because of the decision only, that cost should actually, it will be something that came up only because of that investment. So it was not a cost that you were already incurring. Okay, so it has to be incremental. Finally, it has to be a cash flow. So it can't be depreciation, for example. It has to be an actual cash flow. That is relevant cost. That has nothing to do with activity-based costing. Okay, so it can't be A. Activity-based costing cannot be used to cost services. That is wrong. You can use it for both products and services. Activity-based costing is a form of absorption costing. That is true. I told you that today itself. I told you absorption costing, the only thing is we take the entire overhead cost divided by a suitable base, one base. Here, we take all the overheads separately and divide it by separate bases. That's all. But otherwise, it's absorption costing only. Only thing is we are not, amalgamating everything and doing it together. So C is an answer. Activity-based costing is an alternative to traditional volume-based costing methods. That is also true. Volume-based costing means we took the overheads and, divided by something like activity or labor hours or something. Here, it's an alternative to that. Okay, so the answer is C and D. Okay, which of the following is a disadvantage of the payback method of investment appraisal? Okay, so this is the first time I think in this TRG we are moving into capital investment appraisal. Okay, so this class and the next class we will move a little bit into that. So what is investment appraisal? Let me explain that to you. So investment appraisal means methods that you can use to decide what investment to go for. Now, why do we need methods? Think about it. If you are a business, you obviously don't have unlimited cash. Now, unless you are really rich, you're a multi-millionaire or a king or a queen or something, just saying, you won't have unlimited cash in hand. Okay, so most businesses, we have only limited amount in our hand. So the thing is, with the amount that we have to make sure that we invest it in the most profitable project. Okay, now let's say we have 100,000 in hand and let's say there were two projects. One project, we invest 100,000, we get a return of 20,000. And another project, we invest 100,000, we get a return of 50,000. Then obviously, we have to go for the second project because it's giving us a bigger return. Okay. Now, if we are, a lousy company, then what we might do is after we invested in the first project, we will realize, there's a second project. We should have invested in that. But the 100,000 is gone. Okay. So that is where investment appraisal comes in. So basically, before you take a decision, you have to carry out an investment appraisal technique, and that will help you decide which one is a good option to go for. In your syllabus, we look at three main ones: net present value. We look at this next class, I think. Or might come up this class, I'm not sure. Depends on how fast we go. IRR, internal rate of return. And the third one is the payback. Okay. Now, net present value IRR, I will talk about it in a bit. We'll talk about payback now because this question is talking about payback. Now, payback is a method where we try to reduce our risk as much as possible. How are we going to reduce the risk? If I invest 100,000, okay, let's say I invested 100,000. If I want to have a low risk as possible, then the best way to do that is to quickly earn back that 100,000. Because I'm putting it in, okay, I'm putting it into a business. Now, until I earn that 100,000 back, it's risky for me, right? Because if I don't get to earn it back, then it's such a waste of that 100,000. Instead of putting it in the business, at the very least, if I had gone and put it in a fixed deposit, at least I would have earned some interest. Okay. So payback, what we try to measure is how long it takes to earn back the investment. How long it takes to earn back the investment. So the quicker you earn it back, it's the better, because the risk is low. Okay. But there is a problem with payback. And what is that? You only consider the time period, or we are only interested in the time period where you're earning the 100,000. So the first year, the second year, the third year, maybe in the third year we earn it back. After that, what happens in the fourth year, fifth year, sixth year, we don't care. Because we have earned it back, so that's enough for us. We don't have to think about anything after that. But then there may be some projects where maybe year 1 to year 5, it's actually low return. Okay, 1 to 5, maybe we have a low return. But thereafter, maybe the 6th year, 7th year onwards, it's excessively high returns, really good returns. But then if you're going to use payback, then you would have rejected this project. So that is a disadvantage. Okay. So how do we decide? Are we going to accept or reject? There will be a target payback period. So the company will decide our target payback is going to be 3 years. If an investment is not earning back our investment, if a project is not earning back our investment in 3 years, then we won't accept it. Okay, but then again, like I said, the problem is some projects maybe there is low return in the first 5 years, but thereafter you get extremely high returns. So you will lose out on those kind of projects. Okay, so that is the disadvantage of the payback method. Right. So now let's read one by one and see what is the disadvantage of payback. Okay, so that's what the question is as well. First one is saying it may lead to excessive investment in short-term projects. That's actually true, because we are only focusing on how long it will take to earn back our return. So if our target payback is 3 years, we will focus on projects that, have a short life, because only then will you earn back that investment quickly. But sometimes there can be long-term projects where in the first few years they are not so profitable, but after that they become very profitable. Okay, so that is correct. A is actually a disadvantage. B, its use will hinder liquidity. Liquidity means you don't have cash in hand. Cash flow is not available. That's not true. You know why? Because we are always talking about trying to earn back the money quickly. So that means we are trying to get the money in hand quickly. So that will actually help with liquidity. It's a fairly complex technique, not easily understood. That is not true. And obviously, everybody can understand this, right? If you can earn it back quickly, it's good. Anybody will understand that. Okay? It tends to maximize financial and business risk. It doesn't maximize any risk. It reduces your risk. Okay? So it can't be D as well. The answer is A. Okay. Then we are looking at another theory area. Which four of the following are aspects of value analysis? So if you have a product, we are asking what are the aspects of value to the customer? Okay. So esteem value, exchange value, use value, and cost value. That's the answer. Net realizable value is, it's actually selling price minus cost to sell. That is net realizable value. So 1, 2, 4, and 5. 1, 2, 4, and 5 is, no, wait, 1, 2, 4, and 5, D. Okay. So let me quickly explain this. If a customer has your product, it will be valuable to him, obviously. Okay. Now, some products, they have use value. Now, let's just take an iPhone, for example. The ability for him to make calls, the ability to send a text, to watch a video, everything is use value. Okay. Exchange value means how much he can sell it and get, if he sells it or gets another product, how much he will be able to do the transaction for. Okay. Cost value means how much it actually costs him to buy the iPhone. Esteem value means the amount of prestige that he has when he uses the iPhone. Yeah, that is the esteem value. So all four types of value, the amount that he gives to pay, the amount that he will get if he sells it, the the amount that although use value, there is no real monetary figure, the amount it actually means to him, no? If not for that phone, he can't use, he won't be able to call or anything. So that has a value, and the prestige of using the iPhone, that is the esteem value. So 4 types of value, you just have to know it, right? You don't have to explain to anything. Just know it's use value, cost value, esteem value, and exchange value. Okay. The next one is easy. I'll give you 3 minutes or 5 minutes max. See if you can get the prime cost of a whoopee. What do you think? Try it out. I know it's like, like a mountain of questions falling on your head. I understand that. The thing is, guys, to be honest with you, these questions, I usually do it with students in my class. I do it soon after I'm done with the lectures. Okay, so as soon as I'm done with the slides and I've gone through all the chapters, I go through all of this. Okay. Now, if you were a student in my class, then the thing is, all of these techniques that I'm talking about, it would have, you would have already heard it before. You would have already heard it before. My slides, everything, you would have seen it, right? So, when you're doing these questions, you won't really feel like, I'm learning a lot, it's too much. You don't feel that, because half of it or 3/4 of it, it's already old stuff that we already have gone through in class. If you're a newer student, then my techniques, my slides, the way I do the question obviously will be slightly different for you. So you might feel that it's a lot of information. Okay. But, bear with me, because by the end of the TRG, my point is I just want you to be exam ready. Okay. I know, because now my intention is not to make this TRG easy for you. If that was my intention, I would have just chosen 2 or 3 questions and, made you do it for 1 hour. I will do it for the other hour and call it a day. But my point is, I want to cover as much of the syllabus as possible, because somebody who is joining the TRG obviously has forgotten his theory. That's why you have joined the TRG in the first place. Okay. So that is why I have taken a mixed bank where there are questions from all areas and I start talking about everything. Because if I were to do chapter by chapter, if I was going to do like a summary, it won't be enough. 5 days is not enough. I can only do maximum maybe 4 to 7 chapters. We have 18 chapters in this syllabus. Okay. So I understand it. You might feel that there is a lot of information happening, but understand that this was designed not to do that. Okay. So I have designed this not to make you, get scared of MA or anything. I've designed it to make sure that all the questions cover all areas of the syllabus. So definitely after you do the TRG, if you look at the Kaplan revision kit or the BPP revision kit, you will find all the questions easier. Take my word for it, you will find it easier. Okay. But the trick is that you have to remember the techniques that I'm talking about. Okay, because I'm talking about it while doing the question. Obviously, I can't share my slides and all with you. It won't make sense, right? Because if you come to the lecture and if you listen to me only, you will understand what the slide is saying. Okay. So whatever I'm telling you in the TRG, whatever I'm showing you in the TRG, hang on to it and use those techniques to do the questions. It will help you. Okay. And if you have any questions, ask me. Usually TRGs are easier to do for skills level because skills level, the syllabus is a lot shorter. So we can, go through questions and a lot of questions from one area. But MA, the problem is the syllabus is a little vast. So that's why, you'll keep on doing questions and the next question is, there's no real repetition, right? There are so many different types of questions. Can't help it. Get through MA. I promise you skills level in terms of volume, it will be definitely much lower. Okay, so just get through this quickly. Right, so the direct materials involved in the manufacture of a whoopee cost 2 per unit and the direct labor is 2.5. There are also direct expenses of 0.5 per whoopee. Fixed cost apportioned to a whoopee amount to 3.15. What's the prime cost? It's simple. Prime cost is, okay, 3 things make up a prime cost. The direct material, the direct labor, and the direct expenses. Okay, so they're telling me the direct material is 2, the direct labor is 2.5, and the direct expenses is 0.5. So 2 plus 2.5 plus 0.5, prime cost is 5, which is C. Okay. Right. Absorption costing will result in the same profit of will result in the same profit as marginal costing in which three of the following situations. Okay, so I told you about this today also. We have absorption costing. We have marginal costing. Okay. Now the question is asking you, in which situation will absorption costing and marginal costing both give the same profit? Okay, so when do they give a different profit? When do they give a different profit? If there is a change in inventory. If there is a change in inventory, they will give a different profit. Why? Because if inventory increases, absorption will be higher. If inventory reduces, marginal will be higher. Okay. So if inventory levels are constant, if inventory levels are constant, then both will give the same profit. So when inventory levels are constant, yes, one answer is there. When opening and closing inventory volumes are the same, that's also the same thing. Opening and closing inventory is the same, means inventory is constant. So yes, that's another situation where marginal and absorption will give the same profit. When no inventory is held as opening inventory and no inventory is held as closing inventory. So there is no inventory at all. So if there is no inventory, you can't have a change in inventory. Only if there is a change, will there be a difference between absorption and marginal. So here there is no inventory at all, no. So obviously absorption and marginal will give the same profit. When opening inventory is greater than closing inventory, there will be a difference, right? Because opening inventory is greater than closing inventory means inventory has reduced. If inventory has reduced, marginal gives the higher profit. Or closing inventory is greater than opening inventory, then inventory has increased, absorption gives the higher profit. So these two can't be the answer. Answer will be 1, 2, and 3. Okay. 21.13, you can forget about it. This equivalent unit, you don't get anymore. Okay, so we can forget about that question. They don't test anything regarding equivalent units. UCR company has recorded the following costs over the last 6 months. Okay, so we have so many costs, so many units produced. They're asking, using the high-low method, what is the total cost equation? Okay, so that's nice. Since we did high-low method today, you can try it out. Give me a second while I just look at. Okay. Try it out. I know you might be tired. This is the last calculation that we'll be doing today, okay? So after this high-low method, we'll just do these 2 questions and call it a day. Okay. So high-low method, I told you always have the structure in hand. Okay, if you have the structure, it makes things a lot easier. So it's activity, cost, the high and the low. Always you have to choose the highest and lowest activity. So in this case, it's the units, okay? So the highest we have is 3,000 and the associated cost is 74,000. Cost can be anything. You don't have to worry about it. You just have to choose the highest activity level. So 3,000, then we have 1,750. Lowest is 1,500. And the associated cost is 69,500. Okay. Then you get the difference, which is this one minus this one, 1,500. This is 4,500. Okay. Now get the variable cost per unit. So that will be 4,500, which is the cost divided by the difference in activity. Difference in cost divided by difference in activity. 1,500. So that will be 3 per unit. Variable cost per unit. Now we can get the fixed cost. So you have an equation like this. Total cost equals fixed cost plus variable cost per unit into output. There's an equation like this. Now you can substitute the high or the low. I always choose the high. It's easier. Not easy. Both are the same. I always choose the high because then I don't have to think, right? Should it be high or low? That's why. So total cost is 74,000 at the high. Fixed cost is what we want, plus the variable cost per unit, we calculated it as 3. Output at the high was 3,000. Okay. So if you want the fixed cost, we're talking about 74,000 minus 3 into 3,000. Sorry. Fixed cost will be 65,000. Okay. Now, they are not asking you for the total cost at a particular activity. They're just asking you what is the total cost equation. Okay. So I mentioned this, that we change the y equals mx plus c a little and we make it y equals a plus bx, right? Bx. Okay. Now, y is the, the vertical axis. So y is always the dependent variable. X is the independent variable. So let me just put this here. Y is the dependent variable. X is always the independent variable. Sorry. Independent variable. A is the fixed cost. And B is the variable cost per unit. Okay. So now we have to figure out which one is the dependent variable. We have total cost and units produced. Now, obviously, we can control the number of units produced, but the total cost will depend on the units. We can't go and control the total cost. No, that will change depending on the units only. So the dependent variable will be total cost. So Y is the total cost. A is the fixed cost. So fixed cost we calculated as 65,000. Plus B is what? Variable cost per unit. That also we calculated. It was 3. Into X is the independent variable. And here the independent variable is the units produced. This is the equation of the total cost line. Okay, so it will be total cost equals 65,000 plus 3 times the units produced, which is A. All right. Let's just go through the last two as well. Which of the following statements are correct? Strategic planning is carried out by line managers. So strategic planning is usually done by senior managers. There are 3 types of planning: strategic, tactical, operational. Operational is done by junior managers. Okay. Tactical planning is done by middle managers. Strategic planning is done by senior managers. So line managers are usually middle or even junior. So they can't be the ones doing strategic planning. Usually CEOs, CFOs, they are the ones doing strategic planning. Non-financial information is relevant to management accounting. That is true. Okay. So one is, let me check. One is false and two is true. Okay, it's B. They have mixed it up, right? I mean, the answer is correct, but they're saying two is true and one is false. Usually they should say one is false and two is true, right? So yeah, the answer is B. Two is true and one is false. Last one, which of the following sampling methods require a sampling frame? Okay, so basically you should have the population and we should be able to number them. Random you need. If you remember random, you definitely need. Okay, stratified. Yeah, stratified also you need because you have to know the population, 60% men, 40% women. If you don't know that, you can't do stratified. So again, you need the sampling frame. Quota you don't need because you can just go stand in front of wherever you want to do the interview. Whoever comes to you, the first 500 people, you can do the interview and go. So you don't need a sampling frame beforehand. Systematic, on the other hand, you need. Okay, because only if you have the population numbered, you will be able to pick a random start and, choose every nth sample as part of your main sample. So random, stratified, systematic you need. Quota you don't need. So 1, 2, and 4, which is C. All right, that's it for the day. Have a good night and I will see you on Thursday. Next Thursday, it will be a similar concept, but we will look into certain areas that we didn't see so far. Okay. So good night, guys. I'll see you all on next Thursday again, 6 to 9. Right.